Good morning, everybody, grade 12 learners. I hope you can hear me well. This edition this morning for Business Studies, we are going to discuss insurance and investments. Now this is a topic that is very relevant to mine. Sorry, before we go on, my name is Mr. Gr.12. I'm a teacher at Great College here in Bloemfontein. I teach business studies. It's my passion, it's my life. And I hope after today's session, you're going to have the same verve and passion for business studies as I do. As I said, what we're going to do today is we're going to discuss insurance and investments. And as relevant as that may be to your exam that is coming up in a couple of weeks, as relevant is it to life in general. Because after this lesson, I hope that you're going to understand something about insurance and in investments that will help you in your future life, not only just to pass an exam, but really to understand what it is all about and how you're going to use it in years to come. Okay, can we get the PowerPoint slide, please? As I said, my topic is Learning Outcome 2, Assessment Standard 4, and our overview today will look like this. First up, we're going to discuss insurance. Then we're going to put insurance into the context of the real world. Then we're going to discuss the link between insurance and investments, because there's a very definite link. Then we're going to discuss investments, and lastly we're going to finish off with what investments looks like in the real world. You don't have to write this down. First up, what is insurance? Now, I tell my learners every day that insurance is really for madmen. Now, why would you ask me why? And I'll tell you very specifically, because insurance entails the following. You, as an individual or a company, paying money every month, large amounts of money, to a company for really nothing in return. Do you get that? Meaning, I pay compensation, as you can read in the definition, but only if certain events happen. Now, basically, it works like this. I own an asset, maybe a car, maybe a cell phone that is expensive, and I want to protect that asset. So now I will start off paying a company insurance every month, but I won't get that money back unless something specifically that is stipulated in the contract happens. You see, it's a very lucrative thing, because people value certain items different than others. For example, if you have a car and you depend on that car for your transportation, then you want to insure that car properly. This means that if something happens, if I get into an accident, or the car is stolen, or I get hijacked, or the car is damaged in any way, that I would want compensation back for that vehicle so that I can continue on from where I was before. So, the first definition that you need to understand is the term assurance. Now, that's insurance with an A. Assurance is a payment which is made for an event that is guaranteed to happen. Now, it differs from insurance, which is payment for an event which may or may not happen. Assurance is something like, for example, life insurance. We're all going to die. And there's companies that will insure your life for a large amount of money, for a very reasonable premium that you have to pay every month. This means that when I pay the money and I die, which all of us are going to do, then that specific company will pay out an amount of money to my loved ones, the people I leave behind. If we can go to the term insurance, this is more, as I previously explained, for a vehicle or a cell phone or an asset in general, which may get damaged, but if it does not get damaged, I don't get any returns out of that investment meaning I paid the premiums, but I don't get any money back. Okay, we can continue. Insurance rests on a couple of principles. The first principle is indemnification. Now, as you can understand, there's legislation involved here. And the one word that you, as a learner, will have to understand is that there is certain words, certain terminology that you're going to have to master. Can we get the camera, please? Very important. Very important. Can I have your attention? You have to learn your terminology. Terminology is something that I, in these 2 hours that we have together, can explain to you. But the learning and the knowledge of that work is up to you to learn. I cannot learn it for you. You have to learn it yourself. I will teach it and I will explain it so that you understand it, but I can't learn it for you. Certain learners learn in different ways. Some learners want to know all the small bits, all the terminologies, want the knowledge first, and then they get the bigger picture. Other learners say, no. I first want the framework. Tell me so that I can, what I learn, put into context. I'm going to do the latter today. So the first thing that you have to know is in our framework, we're talking about insurance. Now we can get the screen back, please. The first principle that you then have to understand is the principle of indemnification. Now it's a big word, but I'm sure you will at this stage at least understand what it is about. It's a principle that is based on the possibility of loss due to risks that might occur, such as fire or theft. The object of indemnification is to place the insured after the loss in the same position that he or she was in the immediately before the loss. This means that if you had a car which has a market value or a book value of 100,000 rand, and you insure that car for 100,000 rand, that if you crash the car or the car gets stolen, that the insurance company will pay out an amount of 100,000 rand. Not more and not less. They want to place you in the same situation or the same state as that you were before. Very important again that there's a lot of people who commit insurance fraud. There's a lot of people who will say, but my car was worth 120,000 rand. It wasn't worth 100,000 rand. And then they expect the insurance company, to pay out an amount of money, which obviously is not the same or is not in line with the word indemnification or the principle of indemnification. The insured must not be placed in a better or worse position. The next principle that insurance is based on is security. Now this principle is based on the possibility of loss due to events that might occur, such as death or retirement. The object of security is to provide a security in the form of money to the deceased's dependents. Now, as you can see, these two fit in properly with our terminology that we've done before, assurance and insurance. There will be security for assurance, and there will be indemnification for insurance. Terminology. Oh, and I am going to keep you busy with this. You won't believe, because this terminology is very important. And when you write your exam at the end of the year, especially when it comes to section C type questions, the long questions, this is extremely important. It's important that you use these terms. You use the terminology. It will save you time when you write it down, and it will make you sound smart. But more importantly, for life, as we will continue onwards, it will definitely help you. The first term, as we can see, is the term insurer. Now, the insurer is the company. Companies like, for example, Outsurance or Santam, those are companies that insure people's assets. Then the insured is you, the person who has the assets, the person who will pay the risk. The next term is the insurance contract. Now, you all know what a contract is. We've learned about contracts before. This contract has to be properly set up. Now, insurance companies are very good with this. They set up these contracts every single day of their lives, and they try to cover every single aspect of your asset and how it will be insured. The insurance contract will stipulate all the principles of indemnification. The insurance contract will stipulate, it will have a clause, that's another word that you need to know. There will be a clause in the insurance contract that will say that if your car is burned down or burns out, we won't cover it because then it wasn't fixed or whatever. But what they will say, what they will stipulate in the contract is what you will sign or that you will have to agree to. The policy holder, again, that is you yourself. Sometimes we talk about the insured, or sometimes we talk about the policy holder. But the policy holder is usually used in the term assurance, where a person's life is insured, and that person is obviously insured, but he also then holds the policy to be paid out to whomever the beneficiary is. Premium, again, another interesting word. Premium is the amount of money that you pay out, or that you will pay every single month. We can also call it a payment, but the fancy word, the word that you will have to use in insurance terms, is the word premium. Everybody still with me? 1, 2, 3. Everybody with me? Okay. Next one is excess. And excess is amount of money that the insured have to pay the insurer for the claim that is about to take place. Let's do a proper example. You have your car, costs 100,000 rand. You crash it into a tree. It was an accident, wasn't your fault, and you obviously want to put in a claim to the insurer. Then the insurer is going to tell you, sir, there's no problem, we will pay it out. However, you would have to pay an excess. Now, an excess differ. Some companies say you don't have to pay an excess, depending on the contract that you have. But an excess is usually an amount of money. Let's say if your car is written off and it costs 100,000 rand, an excess will be something like 1,000 rand that you have to pay for them in order for them to process your claim. The term risk is another very simple term, but this is what insurance is all about. Insurance is based on risk, because the status quo is always changing. I have an asset today, tomorrow the asset is damaged or the asset is lost, and that is why insurance exists, to cover risk. Now, you won't believe what people insured or insures in life. I will give you some examples later on. The insured value, that's the amount of money agreed by the insurer and insured and insurer to insure assets or life for a person when the contract is signed. Now, the insured value, as I said, if you for example have a car which is worth 100,000 rand, then the insured value is 100,000 rand, and your premiums, remember that word, the premiums that you pay will be according to the insured value of 100,000 rand. Let's say 500 rand a month, or whatever the case may be. The book value, however, that's an interesting thing. If you buy a car today, which costs 100,000 rand, that car will not be worth 100,000 rand in 2 years' time. So now you drive it around, but in 2 years, that car might be worth 80,000 rand, which is the book value of the car. You see, now this starts to get interesting, because I pay a premium of to the equivalent of 100,000 rand, but my book value of the car is only 80,000 rand. You see, so now I actually pay a bit more, don't I? Because when the car is damaged, or stolen, what is the principle of indemnification? The principle of indemnification say, whichever the insurer wants to place you in the same position that you were just before the accident or the risk happened. So if my car is worth 100,000 rand, now all of a sudden I pay premiums worth 100,000 rand, but my book value is only 80,000. So how much are the insurer going to pay out? The insurer is only going to pay out 80,000 rand because they stand on the principle of indemnification. The reinstatement value is whatever the market value is of that particular vehicle. Now, if we can just get to the paper here, I would like to explain a couple of things to you. Let's start off. Excuse my little car. There are you. Hello. You can smile. Okay, you have a big smile on your face, and there is your vehicle. Excuse this vehicle. I was not an artist at school. Maybe it looks a bit like like a hearse. Somebody died. No, a joke. No, nobody died. Right, there's our insurance. For example, or Santam. Everybody good? This individual, which is you will pay a premium to our insurance for driving your own vehicle. If you bought this vehicle for 100,000 rand, this vehicle will be worth 100,000 rand today, let's say in 2013. But in 2015, if you would want to sell this vehicle might only be worth 80,000 rand. Now, whatever you will be able to sell it for, that will be the market value. Okay. Sorry, guys. The book value might be 81,000 rand. Because if you guys know anything about vehicles or those types of assets, you will see that there is a book, literally, there's literally a book, which says that if you own this vehicle and it has this mileage on the vehicle, and the vehicle is 5 years old or 2 years old, then this is what the vehicle should be worth. Now, usually the market value and the book value is closely related to each other. But if you pay out insurance 500 rand a month for the premiums, as a premium, that is worked out on 100,000 rand. So basically, and this is a tip, remember at the beginning I told you that this is all about real life. And one day, hopefully, you are going to own a cell phone or a car or some form of asset that you would want to insure. Why would I want to pay a 500 rand premium if my vehicle is only worth 80,000 rand? Do you understand? So the onus is on you to phone the insurance company and tell them, sir, please lower my premium because I want to insure my car which is worth 80,000 rand. It's kind of a way that insurance companies make money because they can revise your contract every month if they want to, or once a year. I don't know if you've seen the advertisement of King Price Insurance. King Price Insurance has this advertisement. Please, if you watch television, look at it. They say they have low insurance premiums and it decreases every month. And now you think to yourself, but how is this possible? And the whole advertisement is on how can it be possible to lower your insurance premiums every month? Well, this is the principle of indemnification. If your car is worth 100,000 rand in December or November 2013, it will be worth 97,000 or 98,000 in December 2013. And maybe a bit more in January. And maybe a bit less in January, and a bit less in December, and so forth. I hope you get this, and that's why a company like King Price Insurance can lower their premiums every month, because the premium of on 100,000 rand will most probably be 500, but it will most probably be 400 rand when it gets into to 80,000 rand in 2015. So here's a little tip for you. If you insure an asset, make sure that your premiums that you pay is up to date. Okay, now we can get back to the screen. Thank you. Reinsurance is dividing the risks between different insurers. One insurer divides the risk between him and other insurers. The premiums are divided between all the insurers involved, and each of them has to contribute when the specific risk occurs. Cession, this is a very interesting word. Cession is the right which the insured, that's us, has, according to the stipulations of the insurance contract, may be transferred to another person by means of a written clause, for example, your spouse or a bank, or for security purposes. Now, you guys know, at least now, you guys know something about the National Credit Act, and I would like to explain this to you as well, if we can just move along. The National Credit Act says that if I buy a house, this house, let's say the house cost R1 million, this house has to be covered by life insurance. Now, the banks, they are not insurance companies. They have money. They lend money to people, and they keep money safe. That is what a bank, like for example ABSA, that is what their primary function are. So if they borrow money for a house, the National Credit Act says that this money has to be covered by life insurance. Now that's kind of obvious, isn't it? Because if you have a family and you buy a house, and this house cost R1 million, and you owe the bank R1 million, and 5 months later or 6 months later the worst happen and you're in an accident or you die, who is going to be responsible for this R1 million to pay back? That's why the National Credit Act says, but there have to be life insurance on this money. So you'll take out a premium. And banks these days, they do it themselves. They will say, okay, for life insurance on R1 million, we're going to charge you 1,000 rand premium, which you have to pay. You have to pay a premium. But then you say to yourself, but wait a minute, I want to know, if I want to insure my life for R1 million, why can't I go to, let's take another company, Liberty Life? Why can't I go to Liberty Life? Liberty Life specializes, and there's loads of other companies, Momentum and Investec and so forth. Liberty Life also insures my life, but they will give me the same coverage, but only for 500 rand a month. Because banks don't specialize in insurance. That's why their premiums are higher. Liberty Life specializes in insurance. They work out the insurance risks. What your age is, what your health looks like. There is so many things that they take into consideration. And Liberty Life will say, okay, we will cover you for R1 million, but you only have to pay 500 rand. But now, here's the problem. The bank still borrowed me the money for this house that I bought, my house, which is my family lives in. So now this is where the word cession comes in. This term, I cede or cession my life insurance to ABSA. So I still have the life insurance at a different company at a lower premium. I save money, but if I die, the money will be cessioned to ABSA, and ABSA will receive their compensation, and they will be okay with it. And in the process, I save a lot of money. Okay. Subrogation. This is the right of the insurer, after the insurer has been indemnified for loss of damages, to stand in the place of the insured, and to claim the amount being paid for the loss, damage from the guilty party. Now, this is another interesting thing. Many times it happens that you get into an accident, and there's two cars. You drive your car, and they drive yours. They drive theirs, and you crash into each other. But it wasn't your fault. So now your insurance company pays out because they have to. You're insured with them. But now the subrogation says that this insurance company may stand in your place to claim that money from the guilty party. Because if it wasn't your fault, somebody else crashed into you, obviously they will have to pay for it. But usually then subrogation means that the insured party or the insurer will stand in your place to claim the money from them. The next word is pooling. It's a combination of several small groups into one large group of insurance for insurance purposes, such as obtaining lower premiums or more group benefits. You yourself, or you and your neighbor, or you and several members of your community may want to say, we have a lot of assets. If I insure my asset alone, it'll cost me 500 Rand, but if I insure my asset with yours in a pool, then I will only have to pay 350 Rand because the insurance is so much, the assets is greater, so the insurance premium will be in relation will be less. Surrender, that is to terminate the policy. It applies to life insurance. A cash amount is paid out to the policyholder, no further premiums are paid, and no further cover is provided. Compensation is the payment made by the company for claims, as we said, just to make sure that you get your money back. And the beneficiary is the person who is nominated as a receiver of any benefit from the insurer. For example, if I have life insurance, if I cover my life for R1 million, and I'm going to, and I have to have a beneficiary, because if I die, then somebody in my family or several people in my family will have to benefit from that, and that's what the word beneficiary means. Sure, I hope you guys are still awake, because this is a lot of terms and it's a lot of things that you have to study, but I'm sure with the proper time and effort you will master this quite easily. Now, can I have the camera, please? Very, very important. The next slide that I'm going to show you is the types of insurance. Now, for the purposes of your 40-mark long questions at the end of the year, this is a very popular question to ask. I'm not sure whether they are going to ask it or not. I haven't seen the paper, but from experience I know that the types of insurance is the main focus of the insurance as a topic. You would have to master these quite well. There's a lot of legislation involved. Again, as you know, we've learned about legislation since the beginning of the year, and this is nothing different. It's also a lot of legislation. We can get back to the slide, please. Thank you. Now, types of insurance. The first part is compulsory insurance. Now, if you're a South African, you pay compulsory insurance. Everybody is obligated to pay it. It's a national thing. It's governed by Act, meaning it's governed by legislation. It's something that everybody has to pay, especially business, because we are, in fact, busy with business studies. You guys would know that any business will have to pay these types of insurance. Now, the first type of insurance is COIDA. It's the Compensation for Injuries and Diseases Act. If you have a business and you have people working for you, it is your obligation. You don't really have a choice. You have to pay compensation for injuries and diseases. If a person that is in your employment gets injured or gets sick from the work that they do, you are obligated to, there is a fund that is obligated to pay out for their injuries. And obviously, you as the employer would have to make a certain contribution to this fund every month. All employers are obligated to register with Gr.12, and employees are entitled to the compensation for accidents and diseases as a result of workplace injuries or conditions unless willful misconduct can be proven. Now obviously this means that if you work in a metal factory, which thousands of people in our country do, and you get injured by a big metal plate that falls on you, if it was your fault and it can be proven, then obviously this compensation won't be paid out to you. But if it's an accident, as most of the times it is, then this fund will cover the medical costs of this specific person. I hope that is clear. The next one is the Road Accident Fund. Now, we can put this into context as easily as we want, but the basics of it is that if you are injured on a South African road, whether you're a pedestrian or whether you were driving in a car, you have the right to claim from the Road Accident Fund. I don't know whether you watch television, but there are many advertisements on television today which claims that they will fight the Road Accident Fund for you if you get injured, if it wasn't your fault. This means if you're in an accident, and they pay quite well, and there's a lot of legislation involved. Let me quickly go through this with you. The Road Accident Fund was established to protect the users of South African roads. The claims against the Road Accident Fund were previously known as third-party claims. These claims are as a result of accidents on the road where road users are insured against injuries suffered at the hands of another driver. Money to sustain this Road Accident Fund comes from a levy included in the price of the fuel. So that's where the Road Accident Fund gets its money from. Every person, if you go to the petrol station, you park your car there and you put in money and you pay, I don't know, how much is it at the moment, 13 Rand a litre for the petrol. Part of that 13 Rand goes to the Road Accident Fund. And that's how they get their money. That's how they make up their money. The insurance projects protects both the insured party and the negligent driver who caused the injuries. The injured party will receive compensation irrespective of whether the negligent driver is rich or poor, insured or uninsured. Claims can be made for loss or damages to bodily injury caused by the driving of the motor vehicle or negligence of the driver of the other vehicle. However, very important, the Road Accident Fund is for people. Okay, so if you are asked a question on the Road Accident Fund, that's the first thing that you can write down to sound clever. The Road Accident Fund is not to insure assets, meaning if my car gets damaged on the road, I can't claim for the car. I can only claim for me as a person, or the person, or any person that was injured. A couple of months ago, we heard on the news there was a trial of an actor who was under the influence of drugs, and he was a singer, and he drove with his car, and he drove too fast, and he ran over a couple of kids walking alongside the road. And all of those kids, some of them died, but some of them sustained injuries, and all of those people could have claimed from the road accident fund. Obviously, they're not going to fix the car with this money. They will only pay for medical injuries to people. So it's something specifically for people. I hope you find this interesting, and I hope you go study this as part, or in keeping in mind that this can be asked as a 40-mark long question. The next one is a very, very popular one. I'm sure you've heard about it before. It is the UIF. And UIF is as certain as death and taxes, because the UIF, if you are an employer or employee, you have to pay money to the UIF. It's UIF stands for the Unemployment Insurance Fund, and if you get your payslip at the end of the month, you can ask your parents, you can ask anybody. If you get your payslip, you will see on the payslip is written your basic salary, and 1% of that salary is deducted from your payslip and is paid over to the Unemployment Insurance Fund. Very important that this fund, you as the employee pay 1% to the fund, but the employer also pays 1% to the fund. So effectively, if you earn 2,000 Rand per month, then 1% of 2,000 Rand is 20 Rand. 20 Rand out of your pocket will go to the road accident fund, and another 20 Rand from the employer will go to the fund. So in effect, 40 Rand of a salary of 2,000 Rand will go to the road accident, to the unemployment insurance fund. Are you guys still with me? Now, what is this fund for? Because if 12 million people in South Africa who's working have this pay unemployment insurance fund, what does the money go for? Well, if a person has to stop working because they are pregnant, especially women, I mean, it's part of life. Then for those 4 months that they get maternity leave, they can be paid from the uninsurance employment fund. If a person gets too ill to work, or you adopt children under the age of 2 years, or there's a death of the breadwinner in the family, then people can go to the unemployment insurance fund and claim an amount of money every month from them. There's conditions, of course. You have to show that you are looking for work and so forth. But if you can properly explain why you want to claim from this fund, there's no issue. The unemployment insurance fund will pay out. The next type of insurance is non-compulsory insurance. Now, non-compulsory insurance is the type of insurance that we've discussed from the beginning of our session. Wow, can you believe it? We're almost busy 40 minutes. I hope you guys are still with me. Non-compulsory insurance is insurance that you can pay if you want to, or you don't. You don't have to if you want to. Many people decide that rather than pay insurance on my car, I'll rather save that money and I will buy myself a new car in 5 years. I don't really worry what happens to my car at the moment. There's something that we call short-term insurance, and that is basically of goods. Now, there's so many things that can happen to goods if you insure them. They can be lost in fire, and so you will have to insure it against fire, against storms. I mean, we've seen the past few years, especially in America, large parts of the country was damaged by tropical storms, and tropical storms is a reality in most parts of the world. And if property gets damaged, you really have to start over. Burglary, if people break into your house. Insurance companies are vigilant about this. They want you to put in burglar fences around your burglar proofing on your windows and doors so people can't get in there, and then they will insure you, only then. theft, if your car is stolen or whatever the case may be. Money in transit. You insure, for example, companies. You have seen this armored vehicles driving around in the streets. I mean, that money that is in the truck, that money is insured. I mean, you have to insure money, especially if it's out in the open. Asset policies, personal policies, and my personal favorite is multi-peril policies. Multi-peril policies basically means it's a combination of all my assets. I will go to one insurance company, I will tell them I have a car, and I have a house, and I have house content like a television or furniture or so forth, and all of these assets I want to insure under one policy against all of this possibilities: fire, burglary, storms. I want to, and that's called a multi-peril policy. Okay, and then we are done with insurance. Can you believe it? Number one, the second part, and this is where for the last 10 minutes or 7 minutes of our session, we're quickly going to talk about what insurance looks like in the real world. Now, they are going to expect you to do a calculation, so please remember to take your calculator along to the exam that you're going to write, because insurance in the real world is a very, very difficult thing. You can see the pictures over here. I just took a couple. Dial Direct, they say they have simple, smart insurance. Outsurance, you always get something out, and Santam Rest Insured. See, these companies are in direct competition with each other. And when it comes to creativity, no one is more creative than an insurance company. Let me tell you a couple of things about what insurance looks like in the real world. First up, outsurance. Okay, can we get the? Sorry, don't worry, I'll get it. Thank you. Let's quickly talk about outsurance just for a second. Outsurance, they are very creative. They were the first company to say, okay, you as an individual, where are you? There you. You as an individual, you pay your 500 Rand policy in a month, and you pay this for 12 months. Now, if you pay this for 12 months, you paid a total of 6,000 Rand for the year. But now outsurance says, okay, we want you to insure your property or your assets with us. So let's sweeten the deal. Let's do something creative, absolutely creative. We say if you paid 6,000 Rand during the course of a year, but you haven't claimed, which means nothing happened to your assets. It's in the perfect condition that it was before. You don't want to claim for this specific year. Then they say, okay, outsurance, we always get something out, and they will pay out something like 10% of your premiums, 10% of what you paid. I mean, and then you will think that this is a very, very big, how can I say, marketing scheme. It's a marketing policy, and it's a good one, because outsurance, for example, is a big company. But it's just a way of how insurance works in the real world. Now, this is a good thing. Let me show you a bad thing. Let's say, for example, and by the way, what I'm about to show you, they are going to ask you in the exam. I promise you, it's been in the exams always. You, as a business, have a store, and in this store, there is 1 million Rand of goods. So the store is worth, for this purposes, 1 million Rand. You decide, okay, I'm only going to insure this building for 800,000 rand. Because I think my goods are only really worth 800,000 rand, and I don't think that everything is going to burn down at once, and I think that I don't want to pay as big of a premium. Now, you insure it for 8,000 rand, and a fire comes. And a fire burns down half of your building. And 500,000 rand of stock was lost. Now you would think to yourself, well, it's not a big problem, is it? Because my building was worth $1 million. I insured it, the content of that, for 800,000. Only 500,000 rand was lost. I'm covered. They have to pay me out. I mean, it's 300,000 rand less, isn't it? Only 500,000 rand was lost. The premium that I paid was 800,000, no problem. You see? And this is where the average clause comes into play. It's another principle of insurance, and very important. It's one of those insurance clauses that many people fall by. If you insure your business, if you under-insure your business by 20%, you can see I insured it for 800,000. It's worth 1 million. If 500,000 is lost, I give you one guess. How much is going to get paid out? 400,000. Only 80%, because you only insured it for 80%. Everybody with me? You see, it's kind of a shock, isn't it? That's the average clause. That's how it's supposed to work. So the formula, I will show you in a moment. The formula basically looks like this. The formula basically looks like this. The compensation that is paid out is the insured value times the damages divided by the replacement value. And this will give you your 400,000 rand that we talked about. Now that's under insurance, as you can understand, and that's kind of a hard thing to go by. Let's say we turn this around, and I'm finishing off with this before we can quickly go have a break. Let's say we turn this around. Let's say my building is worth R1 million. And I insure it for 1.2 million rand. So the premium that I pay is on 1.2 million rand. This is now, as I say, over insurance is 120%. Now, half my building gets damaged. 500,000 rand damages. Give you two guesses. How much are they going to pay out? Aha. Do you get it? They're only going to pay out 500,000 rand. Why are they only going to pay out 500,000 rand? Because of the principle of indemnification. Indemnification says you cannot make a profit from insurance. And that is insurance, ladies and gentlemen. I hope we can have a break now. Go stand up, get some fresh air. We'll be back in 15 minutes. Thank you very much.